Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the market site in Times Square, New York City, we have Joe Cavatoni. He's the head of Americas at the World Gold Council. We're going to take a look at projections for the second half of 2022, which has been a volatile year in the markets overall. Joe, it's great to see you again back in studio.
Thanks for having me.
Since COVID, at least. Let's talk about the first half for gold and its performance.
So gold has had an interesting run for the first half of the year. So at a glance, you might think it's not doing all that well because the performance is, call it down 5-6% year to date. But in relative terms, it's performed very strong. Two asset classes have performed better than it in terms of major asset classes: dollar basket and broad-based commodities, mainly driven by oil. So when you look at it in that context, gold as a hedge, an asset that is a safe haven asset, and its performance year to date has been really strong. Now you're talking about a world where equity markets are off anywhere from 15 to 30%. You're talking about a world where we're trying to look at predicting how the Fed's going to deal with inflation concerns, which we're going to talk about, I'm sure. And you're talking about risk assets moving pretty aggressively. The dollar getting the benefit of that strength, of that risk asset move. So lots of things happening, lots of concerns on the investor horizon. You have the continual concerns around geopolitical risks. You've got the unfortunate case of the Russian-Ukrainian war, and you've got this, like I said, concern around inflation. But really, you're looking at risk assets moving and assets coming off and gold performing relatively well against it.
Well, let's talk about the second half here, because as you and I sit here Wednesday, July 27th, just a few minutes after the Fed announced it's taking up interest rates another 75 basis points, let's think about that entire background: inflation, geopolitics, rising interest rates, economy that is growing but slowing. You know, there is a lot that we have to think about hedging there.
It's a wall of worry. It's a wall of worry. It's a U.S. problem. It's a concern amongst the U.S. investors. It's a global problem. So this is what's actually really interesting about gold. If you look at, for example, the exchange-traded fund market, where gold-backed ETFs are a very pronounced asset class, you'll see that it's holding worldwide in terms of the flows in ETFs. What that's telling us are that investors are still positioning gold as an asset to hedge against those exact risks that you've just laid out. An ongoing war in the Ukraine and Russia. It's a really terrible set of circumstances, but no real predicted ability to tell it when it's going to end. And it's having impact and knock-on effects on not only the financial markets, but also the supply chain issues that are coming along with it. When you talk about inflationary concerns, it's a global phenomenon. It's definitely a concern here in the U.S. The rate move, you know, you and I were laughing about whether it's 75 or 100 basis points. It doesn't matter because we know it's going in one direction. And it's going to continue to go in that direction until the Fed feels like they can get it under control. And you have that same phenomenon playing out around the world with other central banks and the monetary policy that's playing out. So you really have a considered risk environment that's very, very difficult to predict, very challenging to navigate. Again, we talked a little bit about the dollar strength. That's a consequence of risk assets moving and a flight to dollar quality, simply because people are looking at those dollar assets in the positioning of those dollar assets short term to deal with this Fed move.
Yeah, and you know, when we think about geopolitics, when we think about supply chain issues, as you brought up before, whether it's the Fed or other central banks, I mean, moving the interest rate is only one piece of the puzzle. That's not going to necessarily resolve what's happening in Russia or supply chain constraints that we're continuing to see, not just because of Russia, but also you still have that hangover from COVID when we had supply chain gluts, and then now we're dealing with too much demand.
You're absolutely right. Here's another unfortunate factor that's played out in the market that's having an impact not only on the gold market, but on supply chain issues. In China, they're dealing with another wave of COVID cases, and they're going through a substantial amount of lockdown. So if you look onshore in China, you're seeing that a significant amount of people are being impacted yet again by COVID. So we're talking almost in the context of it being somewhat over.
Right.
But it still continues to have global impact in places like China, and it plays out in not only the gold market, but in supply chain issues. So these factors are still there, and we're still navigating, and you're right, one lever at the Fed, is that going to be enough to deal with it? No, I don't think it is. So what you need to understand is how you can position your portfolio, protect it in gap down moments, in moments where you're continuing to try and find the safe haven. That's what gold does really well. It is performing in negative territory year to date, but again, relatively speaking, it's strong.
How much should an investor have in gold, whether it's through the physical commodity or via an ETF within their portfolio? Is there a suggested percentage?
So there are ranges that we talk to people about. On an institutional level, we see the range going from anywhere around 2% up to almost 10, 15%, depending on what your objectives really are. And the reality is, again, you want to find where you need to pare back the risk assets and how you want to complement what you're holding with the asset like gold that's going to play well into a portfolio because of its diversification benefits. So when you look at it relative to an S&P index, for example, it will perform well both on the upside and the downside because it'll track well and correlate to equities on the upside, and it does track well when equities are gapping down in terms of their risk. When equities are flatlining, gold tends to flatline as well. So what you need to understand in terms of the allocation profile is what your objective really is. The higher range that we're seeing these days are where people are really looking at global exposures, mainly equity exposures, and they're allocating larger portions of gold to the portfolio to deal with those big moments where you're seeing 3, 5, 7% gap downs in portfolios.
All right, Joe. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.